Good afternoon, everybody. As expected, the Federal Reserve paused rates last week, and Federal Reserve Chair Jerome Powell also increased the terminal rate expectations from 5.1% to 5.6%. This signals two more rate hikes in 2023. The Fed is putting on its best hazmat suit and tie and trying to drown inflation in an acid vat. But there's still a lot of work to do. That's the headline today, but I want to move on because I want to discuss what the Fed's policies have destroyed, because they are surprising opportunities in the aggregate mess that is Fed policy. Yes, anti-competitive, destructive policies ordain winners and losers, and I've said many times that I can't stand this system, but it's my job to bring these opportunities to you, starting in Silicon Valley, where American startup dreams have gone to die. Here's what I mean. As Cis Group notes, just 7 stocks have pulled this market higher in 2023, and Microsoft now holds a market weight in line with the bottom 50 companies combined in the NASDAQ 100. As you can see in this chart, Meta, Amazon, Apple, Microsoft, Google, Tesla, and NVIDIA were up 53% into the beginning of June, while the S&P 500 was up 11%, and the remaining 493 companies were flat. That is very, very important. And what we want to see looking out before we saw this market take off over the last 3.5 weeks, and that 53% gain for through June 1st is before momentum went positive that day and the markets have continued to rally higher. Now, headlines would suggest that the rise is solely due to sentiment around artificial intelligence. But what if there's a factor that everyone is overlooking? A few weeks ago, John Deere and PepsiCo took part in an AI conference showcasing the role of next-generation technology in future operations. For months, media reported that AI would unleash incredible profits for companies. S&P 500 stocks would require fewer workers. AI would unleash profitability and expand margins. But after that conference, no cyclical or industrial company that presented at the event rallied on AI the way that NVIDIA and Amazon have since the start of January. Not one. The other factor at work here is the Fed factor, those anti-competitive, destructive policies that I mentioned a few seconds ago. Their competition, NVIDIA's and Amazon's, has imploded. And higher interest rates have created a series of anti-competitive situations that should only fuel optimism in the great technology oligarchy growing out west, growing and growing like a malignant fungus. Low interest and zero interest rate policies over the last 15 years fueled the ballistic rise of big tech. That rise enabled some players to run amok, to play fast and loose with right and wrong. We've witnessed tech executives engage in widespread surveillance practices, media suppression, and other government-sanctioned activities. That apparatus didn't emerge spontaneously or by accident. One might believe that big tech's origins arrived on the back of the breakneck growth and product innovation. And that's what the hype machine says, at any rate. The hype makes it too easy to overlook a key player in the great rise of the technology oligarchy, and that is the Federal Reserve. Take a look at what they've done. Back in 1993, the central bank under Chair Alan Greenspan began a practice of inflation targeting to offset deflation fueled by technology born in the first iteration of Web 1.0. The Fed's monetary practices have papered over deflation with cheap money, lower interest rates, and all the consequences that favored this particular kind of industrialization. Following the dot-com bubble, survivors enjoyed low interest rates and cheap capital, and so too did investors who accelerated investment in risk assets despite the dramatic internet crash of 2001 and 2002. The Federal Reserve turned up the dial to 11, maximum overdrive, on these cheap money practices after the 2008-2009 crash. And for roughly 13 years, lower interest rates provided legacy names like Alphabet, Amazon, and Facebook, now Meta, with access to cheap capital. This allowed them to borrow for expansion, buy competitors, see Facebook's purchase of Instagram, for example, and fund their explosive growth rates. In addition, companies could borrow on the cheap and buy back stock, setting a precedent that boosted earnings per share and increased the value of their stock. Investors also aided by cheap money and low rates, chased these stocks higher. So, decades of cheap money cash flow advantages enabled these scaling tech giants to expand beyond their core businesses. Now, remember, Amazon, Alphabet, and Microsoft, and all these other leading names didn't start out angling for artificial intelligence dominance. In fact, Amazon started as an online bookstore. Today, Amazon Web Services is a major player in government contracts and fuels most of the internet, the entire internet. Amazon's e-commerce platform dominates all online retail. It has a market cap worth more than 1.3 trillion. Microsoft and Google have similarly modest beginnings and narrow aims, computer operating systems and search engines. Cheap money enabled all these companies to buy other businesses, build their own venture capital divisions, speculate, and fail in other lines of businesses like Amazon's failed phone experiment. And all the while, they've adequately beaten up venture capital names that aim to disrupt their business models. After a decade of building conglomerate status across next-gen technology, they're moving out into bleeding-edge technology areas like genomics, AI, self-driving cars, and more. And they establish market dominance in all of these new forms of technology. Meanwhile, venture capital has imploded over the last 18 months. Last week, the Wall Street Journal released a distressing analysis, and they found that many startups are now unable to secure the funding they need. To say that VC has been suffering would be an understatement. Tom Lavero, a general partner at VC shop IVP, said the mass extinction event for startups is underway. Venture capital losses over the last 2 quarters are key to understanding why the top 7 NASDAQ stocks are thriving. PitchBook data shows that the annual internal rate of return for the third quarter of 2022 hit negative 7%. So for every dollar that you invest, you are down to 93 cents. That's the worst annualized return since 2009. And more startups are closing shop, and others aren't even getting off the ground as deal activity dries up. What's more, Silicon Valley is being starved of talent. As brains literally evacuate the venture system, they seem destined to take refuge within the walls of these big tech fortresses, resulting in a bullish scenario for big tech, but a bleak outlook for startups. And so, these tech startups will also benefit from the buyer's market in human capital. In addition to winning the human capital race from the collapse of venture capital, there are other competitive advantages that these giants hold over startups and mid-level companies. High interest rates create barriers for new competitors, especially startups. It becomes more expensive for smaller companies to borrow money for expansion or for R&D. That disconnect offers big tech a competitive advantage due to its capital access and its financial strength. In addition, any big tech giant sitting on a cash hoard will enjoy some other special advantages. What other advantages? Well, they can buy short-term bonds with cash returns and other investment portfolios. This boosts profitability while their smaller competitors flail in the wind looking for capital. Do these companies have a lot of cash on hand? Of course they do. But let me show you where it actually comes from. Consider another bastardized incentive created by central banking and bad policy. Large tech names like Amazon can utilize their invoice payment strategies to starve out competition. As I've discussed, Amazon doesn't pay its vendors for 45 days after the company sells a product on its platform. So if a vendor files an invoice in June today, Amazon has until mid-August to pay it. Amazon is effectively receiving a 45-day no-interest loan from its vendors. There are trillions of dollars locked up in the trade credit system. We're not talking about peanuts here. Amazon had nearly $80 billion in outstanding accounts payable at the end of 2022, and the bulk of those payments are to those vendors. While small businesses are dealing with higher costs of capital, especially on short-term loans, the business practices of delayed invoicing payments offers a massive capital advantage over its rivals and the vendors on the platform that sell similar products to Amazon's Essentials line. So if you sell a yoga mat on Amazon the same day that Amazon sells its own branded mat, it keeps your payment for 45 days while its payment goes directly into its revenue stash. That will drag on your company's cash flow and impact your manufacturing capacity. It's the most anti-competitive business practice I have ever seen, and no one in Washington is paying attention to it at all. And Amazon's accounts payable expands every single year. Now, there used to be a banana republic, but now there's Silicon. And speaking of anti-competition, let's discuss the final point of what this ecosystem has produced. The K Street revolving door, politicians making beelines for cushy private sector gigs, and hundreds of millions of dollars spent on regulatory capture in Washington. Regulatory capture. What is that? Well, imagine a Chinese mining company sliding cash across the desk of a civil servant in Zimbabwe in exchange for writing the rule book their way. Not a big stretch of the imagination, right? Well, that's regulatory capture. And it's happening here in the United States on an unprecedented scale. Not a nation of laws, but of lobbyists. Amazon, Alphabet, Apple, and Meta spent more than $55 million on lobbying the federal government in 2021. And that doesn't mean directly to Congress. The spending is directed toward agencies as well. And for them, it's money well spent. The FTC has largely ignored anti-competitive practices at most of them, and I tried to get them to take a look at Amazon's payment practices. But meanwhile, what is the government focused on stopping right now? Not big data collection or personal privacy restrictions. The focus right now is on cryptocurrencies, the projects behind the decentralized Web 3.0, which is the only real disruptive threat to centralized platforms like Amazon and Google. It's easy to blame anti-competition on ruthless executives, but all you have to do is follow the money. It will usually lead you home back to monetary policy that has created the have-nots and the have-yachts over the last 30 years. So as I said before, I can't stand this on a personal level, but it's my responsibility to show you where the opportunity is, not whether it makes you feel all warm and fuzzy. For now, thanks to the Fed, this is where tech innovation and profits are. It's an ugly neighborhood, but we must be here. Don't short these names when momentum turns against them, but rather buy them when the tide is turning their way and momentum turns positive. For heaven's sake, please don't shoot the messenger.